Heavy rains and unpredictable weather dictate the fate of millions of acres of farmland every year. Standard assumptions price agricultural machinery stocks as monsoon-dependent cyclicals. This pricing model obscures the rare, long-term compounding opportunities hidden within the sector. VST Tillers Tractors Limited operates within a specific, dominant niche that separates it from standard auto ancillary companies. That niche is the mechanization of small and marginal farm holdings across India. The business functions at the base of a structural shift. Seasonal weather patterns represent a temporary distraction from the core valuation. This dashboard illustrates the dual forces impacting VST's current valuation. On the left, we have the immediate macro environment. Short-term revenue remains sensitive to unpredictable geopolitical export drops and irregular monsoons. The adoption rate of small farm machinery provides a continuous, multi-decade tailwind. To understand the entry points, we will first deconstruct the company's recent segment growth and then evaluate the underlying economics of their electric vehicle platforms. Finally, we will translate these data points into a specific step-by-step capital allocation strategy. The data supports a clear thesis. VST is an emerging compounder where near-term cyclical noise creates the entry points for long-term wealth generation. This image captures India's agricultural underpenetration. Millions still rely on intense manual labor and hand tools in difficult, dry soil conditions. This manual labor represents VST's uncaptured total addressable market. Contrast those hand tools with a technological solution built for these environments. A specialized power tiller operates deep in flooded paddies, designed for marginal terrain. Fourth quarter hard data proves this transition from manual labor to machine is actively scaling. This chart shows year-over-year growth across VST's segments. Power weeders grew at 52% and power tillers at 35%. This 52% expansion demonstrates high market share in a specialized category. Together, they form an insulated core business. Compare this core performance against domestic tractors, which grew at a slower 19%. Revenue is distributed across multiple adoption curves, proving the business is not reliant on a single product cycle. The shift from hand labor to specialized machinery on marginal farms creates a 10 to 15-year structural runway, providing a floor for VST's baseline valuation. Beyond traditional internal combustion engines, the next major catalyst for VST is the rollout of electric vehicle farm equipment. For a marginal farmer, EV adoption is driven by one mathematical metric: total cost of ownership. This tracks total cost of ownership over 10 years. The internal combustion line starts lower, but rises steeply due to fuel. The EV line flatlines after a higher initial purchase cost. By year 3, the lines cross, and operational savings increase net yield. We must acknowledge the execution risk. The electric farm equipment category is currently unproven, and the shape of the adoption curve remains uncertain. Executing this rollout allows VST to secure a first-mover position in the electric farm equipment subsector. A successful rollout translates to a valuation re-rating, shifting the asset toward the premium agritech segment. Recent management commentary provides a look into the company's internal expectations. This compounding bridge chart projects VST's revenue trajectory toward a target of 3,000 crore rupees by FY30. Reaching that milestone requires a compound annual growth rate between 24 and 26%. The path includes downward spikes driven by monsoons and geopolitics. Management refused to provide near-term guidance, accurately categorizing the current year as tricky and burdened by too many variables. The data backs up their caution. A 20% drop in third-quarter exports proves that international expansion is currently a weak link in the model. Executives are projecting extreme near-term caution, yet they remain committed to their long-term FY30 targets. This pattern earns management an 8.5 out of 10 credibility score. Rather than overhyping a fragile macro environment, they utilize conservative signaling to manage expectations. The takeaway for capital allocators is to expect operational noise over the next 2 quarters, while trusting the underlying compounding visibility. We will now translate these fundamentals into a specific portfolio strategy and valuation framework. VST is not a deep value play. The structural tailwinds justify a premium multiple compared to legacy agricultural peers. This fair value matrix shows the pricing parameters required for entry. The shaded horizontal band maps out a fair price-to-earnings ratio of 25 to 35 times. That 25 to 35 PE multiple is mathematically justified only as long as baseline revenue growth remains above 20. Mandates targeting aggressive alpha can scale up to an 8 to 10% maximum allocation. On the downside, a 20 to 25% stop loss from your cost basis is mandatory. The context for that exit is critical. The stop loss must only be executed if there is a structural break in the mechanization thesis and not merely a seasonal earnings miss. VST Tillers combines a dominant market share in its core segments with future optionality in the EV space. By exploiting the cyclical noise that terrifies average investors, sophisticated capital allocators can build a position in a structural emerging compounder.